Hello everyone, welcome to episode 2 of Your Money, Your Taxes. I'm Paresh Shah, Wealth Strategist with Paresh Shah Financial Services, and with me here is Mr. Lalit Abichandani. Hello Lalitji.
Hello Paresh.
Lalit Abichandani is a CPA. He runs a CPA practice from Manhattan and is very successful and has been running his practice for the last 25 years. Lalitji specializes in several industries like regular trading businesses, healthcare industry, IT industry, hospitality and entertainment industry. He's done hundreds of offshore voluntary disclosures and streamlined procedure cases and has become an expert in foreign bank account reporting and the US-India tax treaty. He is an advisor to businesses, professionals, Bollywood industry, and a lot of film personalities. Awesome, Lalitji. Great to have you here.
Thank you, Paresh.
And I think, today's show, since we're just doing this bang in the middle of tax season, so I think today's show we would like to talk to you about income deductions and income adjustments, which can help people minimize the taxes. So my first question to you in that area, Lalitji, is can you tell me what are the different income classifications?
Paresh, before even we go into the income classification, let me just remind viewers that as a US taxpayer, you are required to file taxes on your worldwide income. So whatever income you have overseas, or if you have some bank accounts overseas, you have to report. This has become a very hot topic, so I thought it was important to start with that and remind viewers that when they go to their CPAs or tax advisors, that they include that as well. Now, having said that, the income is basically classified into 4 areas. The first one is earned income, next is passive income, the third one is retirement income, and finally, if you have any other income that cannot be classified, is known as other income. So you add up all this and that's your total income.
Lalitji, I know you deal with this every day, but can you explain in this little simpler terms for our viewers all these 4 classifications, a little more in detail so that they can understand better?
Sure, Paresh. So the first one is earned income. Everybody goes for a job or has a business. So when you have a job or a profession that you are working at it personally, it is, and the income that you generate is earned income. Also, if you are self-employed, you own your own and run your own business, and you make self-employed income, that is also earned income. The next category is passive income. That passive income is when you invest your money and your money earns income. I'll give you some examples. For example, interest income, dividend income, or you might have capital gains from stocks. You might have capital gain from sale of real estate or sale of businesses. All of that is passive income. The third category is retirement income. After working for a number of years, when you retire, you collect Social Security, you collect pensions or distributions from retirement accounts. That is classified as a retirement income. Now, in addition to that, if you have any other income, then that has to be clubbed with other income. Now, at the end, you add up all this and you arrive at the total income, and this total income then can be adjusted or deducted to arrive at a taxable income. So we can talk about adjustments and deductions as well.
Right, I know you mentioned adjustments, and I think adjustments would be very important as far as reducing taxes are concerned. But before we go to that, I just, in the first question, I heard you mention worldwide income. So, income earned overseas, do we have to pay taxes on that as well?
Yes, absolutely. US government requires you to file or report your worldwide income. You may be earning interest income, or if you have some partnerships or some family income allocated to you, you have to report that on your US tax returns. And then tax professionals like me, we try and help you in avoiding the double taxation. Based on the US-India tax treaty, we reduce that tax exposure and there is no double taxation then.
Wow. So worldwide income has to be reported, and we have to pay tax on that here in the US. I think that's a very detailed topic, and I think we'll take up a subsequent episode entirely on that topic, Lalitji, with you. You know.
Sure, I'll be happy to do that.
Yeah. So you mentioned adjustments at the end of different types of income, and so tell us about what are these adjustments and why are they important?
So these adjustments are also known in our language above the line deductions, meaning these adjustments are reduced from the total income. And there are various different classifications. I'll name few. For example, if you have a health savings account, or if you have moving expense deductions, or if you are contributing into IRA or SEP plans or pension plans. In addition to that, you may be paying alimony or educational fees. Also, you can deduct the student loan interest that you may have paid for your children. So as long as they are dependents, you can adjust your income from that as well. And once you adjust these things, we arrive at what is known as adjusted gross income. We as professionals try to look for these adjustments and minimize your adjusted gross income. This is a very important number on the tax return. It's the last line on 1040, but all the tax rates and attributes are based on this number. So it's very important that we try to bring it as low as possible.
So if I understand this correctly, what you're basically doing is taking all the incomes, adding them together, and then you're using the adjustments as a reduction so that the final bottom line number on the 1040 is minimum, and that number being minimum will help in the person reducing his taxes. Am I correct?
Absolutely. Now, in addition to that, there is also an area called deductions.
Right. We'll come to deductions. I'll definitely want to ask you about deductions. But before that, you in the question that in the answer that you mentioned alimony as an adjustment, but you did not mention child support. I mean, that kind of threw me off. Was that deliberate, or was that is that like you can do one and not do the other? Can you elaborate a little bit, please?
No, and there is a reason why I did not mention it. In a general divorce, in a typical divorce, there are two payments. There is an alimony and there is child support. When you pay alimony to your ex-spouse, you get a deduction from your tax in your taxes, and the person who's receiving at the other end, your spouse, they have to report that as an income. Whereas the child support is termed as a personal expense. That means that's a family's personal expense, and you do not get deduction, and your spouse does not have to report that as an income also. So it's basically the alimony which gets adjusted, not the child support.
Okay, I thought I missed something, but yeah, it's important to understand that alimony is an adjustment while child support is not. So now you mentioned two terms. You mentioned adjustments and then you mentioned deductions. So tell us about deductions and what role they play in taxation.
Paresh, so these deductions are allowable expenses. In a normal day-to-day life, we have expenses, and the government has categorized basically into two areas, and they are known as standard deduction and itemized deductions. So you can take either one of them depending on your circumstances.
Again, I'm sure you deal with standard deductions and itemized deductions on a daily basis, but can you explain for our viewers exactly what is standard deduction and what is itemized deduction? Can you give a little more details, please?
Yeah. So standard deduction is a simple version that IRS has termed, and they arrive at a fixed amount each year for each category that you can take as a standard deduction. It's a catch-all of all the expenses that you are otherwise allowed, which you can itemize. If your itemized deductions are more, then you can take more. But if you don't have that, or if you don't have the receipts, you can take the standard deductions.
Okay, so if a person is taking standard deduction, that means he does not have to have too many records or too much things. He can do it. And itemized deductions are then those which he has to keep a lot of records for them, etc. So going into itemized deduction, when you're talking about record, that means there must be a long list of these things that are possible to take. Can you elaborate a little bit on itemized deductions, please?
Yeah, there is a whole chapter on itemized deduction, and there are a lot of itemized deduction. I'll just name a few of them. which we go through in our day-to-day life anyway. For example, medical and dental expenses, the state income taxes that you pay, the real estate taxes you pay, or the sales taxes you pay, the mortgage interest, the charitable deductions, also job-related expenses, for example, your travel or uniforms or computers and equipments you may have used. Or sometimes you take an extra class here or there to improve your job. So you can take that. In addition to that, there are miscellaneous expenses as well. So these are some of the categories of itemized deductions, but you have to add them all methodically to take the maximum advantage.
Wow, that sounds like a lot of things to take care of when we go to our CPA and to do our taxes. But I am sure that as an expert in this area and having so many years of experience, you must be knowing some unique ways in which we can maximize some of these deductions. Some things which you have seen, that an average person tends to forget or does not take into account. Can you highlight some of these deductions and ways to maximize them?
Absolutely, Paresh Ji. We have seen a lot, and we keep repeating to our clients every year that these areas of deductions have to be looked at very carefully and itemized very methodically. For example, medical expenses. I'll just give you one or two examples here. When you have medical expenses and you're paying co-pay to hospitals and doctors and pharmacies, in addition to this, or even the health insurance that you're paying, in addition to that, the IRS also allows medical miles. And the IRS gives you 23 cents a mile to go back and forth to the doctors and the hospitals. Now, during the year, you could have several trips, and you can itemize that and take at 23 cents a mile. In my practice, I have seen for most part, people miss out on that. They don't bring it, they don't have it, they don't have any record. So I stress on that people should pay more attention to that and include medical miles as well. In addition to that, I'll give you one more example without going too much in detail, and that is charitable deductions. Now, all of us, we do some kind of donation or charity. We go to temple or we give money to exempt organizations, and most people don't collect the receipt. Now, unless you have receipt, you're not going to get a deduction. So I stress that people, even when they are giving to temples, they should walk up and collect a receipt for the charitable donation that they have done, so that they can itemize and save some taxes on that. Even non-cash charitable deductions, for example, we give out clothing and furniture to Salvation Army. Make sure you do collect that receipt. Again, I've seen far too many times that people don't collect the receipts, and unless we have the receipts, we cannot take any deduction.
Well, to be honest with you, Lalitji, I'm guilty myself of not having kept the receipts adequately, and I did not know about these medical miles deductions. But one of the other things that you mentioned was about education expenses. Now, there is a crisis out there. As an advisor, I see that college education has become so expensive. So what about those expenses which parents are doing for their children these days? Can you tell us about how they can be claimed or how they can be deducted?
The college education is very expensive, but IRS gives you a very limited allowance for that. They only give you, in the adjustment that I talked about, they only give you $4,000 deductions. So you have a choice of either taking $4,000 as an adjustment, or you can take $2,500 in tax credit. Now, but for that you need a receipt from a college, which is known as 1098T. You must have a 1098T to take the tax credit. So tell your child or tell your educational institution to give you a 1098T so that you can take this tax credit. And it's a $2,500 tax credit, which can be adjusted dollar to dollar from your taxes.
Wow. Thank you, Lalitji. I mean, we're running short on time today. We would have liked to ask you a lot more questions. Thank you so much for all this great information. Thank you, viewers, for watching our show, and we'll look forward to being with you again in 2 weeks' time, where we shall be discussing IRA accounts. Thank you, Lalitji.
Thank you again, and we'll see you again in 2 weeks.